comments. Okay, so today, just want to share a little bit about what I'm doing. I'm trying to set up these tax advice seminars, and I'll be doing those on Thursdays at 11. So those will be Thursday at 11. I also will be introducing, in which I was sharing, I wanted to share the little presentation. I'll be doing entrepreneurship series, and I'll be interviewing entrepreneurs all over Orange County, and basically interviewing them to hear their stories of how they made it, any advice that they could give new entrepreneurs that might be going into that type of business. So I'm really excited about that. Next Monday, I have this coming Monday, August 14th, I'll be interviewing Noriko Weinstein of Benji's Restaurant. She'll be my first entrepreneur that we interview. And so hopefully you can join us Monday at 11. And we will be doing a live interview with Noriko and visiting Benji's Restaurant in Delhi. So I'm looking forward to that. And on August 21st, we will be interviewing Tris Mahaffey of Mahaffey Amplifiers, and learning about his story of how he came up with the amplifiers, and just the ins and outs of becoming an entrepreneur. And he's in manufacturing, so just a different type of entrepreneur. So hopefully we can give you some value at that, and you'll tune in to those. Those are on Mondays. And on Tuesdays, I'll be doing a QuickBooks little presentation, same time, 11 a.m. Hopefully you can grab your brown bag and have lunch with me. All right, so today, and I guess I've been informed that my Google isn't working, as far as you can't log into the Google. So we'll figure out something else as far as the presentation is concerned. So anyway, we're going to talk about IRAs. And actually, I took a poll on the Altera Business Solutions and my personal Facebook page to see what type of questions or what type of educational videos that you might want to see. And the first one, there was a couple, and the first one was my sister, and she wanted to learn more about IRAs. So I put together a little presentation about IRAs. I'm going to talk a little bit about IRAs, and then as we get in, if you have any questions, feel free to go ahead and make comments in the comment section, and I will respond. Hi, Eileen. Nice to have you. Anyway, okay, so I'm going to start really basic with IRAs, because I'm not sure if everybody knows what IRAs are. There are many different types of IRAs. We have individual IRAs, and then we have simple IRAs that are for businesses, and employer IRAs, and we have IRAs for disabled folks that are allowed to put money away for their disabilities. But today we're going to focus on two of the primary IRA accounts, the ones that most of us are familiar with, and those are your traditional IRAs and your Roth IRAs. And basically, they follow the same guidelines pretty much as far as contribution limits, and there are no deductions for the Roth. So yeah, primarily so the difference between a standard. So let's talk about the traditional IRA. Okay, so first of all, the traditional IRA reduces your overall income. Okay, so if you are within the income limitations, you are allowed to deduct 50% of your contributions to your traditional IRA. And for 2023, the IRA contribution limits are $6,500 for people under 50, and if you're 50 and over, you can contribute $7,500 into your traditional IRA, and you can deduct, if you fall under the income qualifications, you can deduct up to 50% of that deduction. So that's a good way to, let's say if you have some self-employment income and you want to offset your self-employment income and you want to give a little to your retirement and a little less to the government, that's a good way to do that, okay, with the traditional IRA. Now, there are, like I said, there are income limitations. And the income limitations, yeah, so if you make it, the income limitations really are dependent on your filing status and whether or not your employer offers you a retirement plan. So if your employer offers you a retirement plan, then you can contribute to your 401k or your employer's retirement plan. But you could also contribute to an IRA if you fall within certain income limitations. And I part of what I was going to give was a handout and basically what the income limitations were. And I wasn't able to upload the actual file document, so I will forward to anybody that leaves their information in the comments section. I will make sure that you get this outline of what I'm discussing today. So just to give you an idea, if you are a single individual and you make less than $73,000, okay, you can deduct the whole 50% of the deduction. If you are a married couple and you make less than $116,000, you can deduct 50% of the total contribution allowance. Okay, so is this all making sense to everybody? Okay, so that's a little bit about traditional IRAs. The nice thing about traditional IRAs is that they reduce your income, so you pay less taxes. Now, the downside of a traditional IRA is that when you distribute or they distribute the funds from your IRA, that becomes taxable income at that time. So you will be liable for the taxes that are on those distributions from your IRA. So that brings us to the other type of IRA. And the other type of IRA is called a Roth IRA. And what the Roth allows you to do, it has the same contribution limits and the same no deductions. You don't get to reduce any of your contributions to reduce your income, okay? But what it does allow, it does have higher income limitations, which is nice. And it also, then when you get distributions, they're tax free. So overall, you can contribute to both a traditional and a Roth IRA. And that's typically what I do recommend, depending on where you are in your lifespan, because you need to think about what are tax rates going to be in the future. So I might be better off to get a Roth IRA because taxes are quite low right now. Okay, so since they're quite low, if I pay in the taxes on my Roth, then in 10, 20 years or whenever I retire, I'm going to be able to receive those funds from that Roth IRA with no tax liability on it. Okay, so I do recommend that if you are in your mid to later life, you need to make sure that you have some tax-free distributions available to you, as well as, so you don't have to be taxed as much on your distributions from your traditional IRA. Okay, so the nice thing about the Roth is that it does allow you to contribute same $6,500 and $7,500 for makeup if you're over 50, but the income limits are up to $218,000, also depending on whether or not what your filing status is. If you're single, head of household, married, filed separately. And there are various rules because, and that's where you really need to talk to a tax professional if you're married and let's say your spouse has a 401k or has a retirement plan and you don't have a retirement plan, depending on income and limitations, whether or not you get a full deduction or a partial deduction. So that's when you really need to talk to a tax professional to determine whether or not you're eligible for those deductions. But right today, I just really wanted to give you a little bit of information about IRAs so that you could at least have a little bit of understanding when you go shopping for IRAs and you're ready. I have people, oh, I really need to get an IRA. I really need to get an IRA, and they're really simple to get. Okay, they're very simple to get. You can get them from your stockbroker, your bank, I don't sell the products. I just tell you how it's going to be taxed and make some tax advice for you as far as the IRAs. Now, also wanted to talk a little bit about what's new for 2023 because there's a lot of changes that's happened within for 2023, and this is really primarily they increased the AGI. That's that income limit for married individuals. They actually increased it for overall, and they went ahead and as of 2023 and the Secure 2.0 Act, I'm going to be giving a presentation on that in the near future. They also increased the required minimum distribution age from 72 to age 73, which takes effect the April 1st following your 73rd birthday. And that's kind of nice because a lot of people are retiring later and they don't want to be taking required distributions out of their retirement plan yet because they might, still be working, might still want to be contributing, but they definitely may not want to take it out at that time. So they are allowing you to wait to your 73rd birthday, April 1st following your 73rd birthday, to make those required minimum distributions. Let's see, what else happened? Does anybody have any questions so far about IRAs? Do you all have 401ks at your work? You can contribute to a 401k and also contribute to an IRA. So the 22,500 is what you can put into your 401k, let's say with your employer, and if the employer matches, you can receive up to 66,000 in your 401k account. So however, if you fall within the income limitations that we were talking about, let's say you're a single person and you're making under 73,000 and you put 22.5 into your 401k, you still could put into your IRA. So the IRA, you can still put into your IRA and still get the full deduction. Not only could you get the full deduction for making the contribution to the IRA, there is also a savings tax credit. And the savings tax credit basically falls under the same income limitations as your IRAs, or as your traditional IRA. However, I just lost my train of thought. So anyway, so we're able to contribute to our 401ks and our IRAs also. So, oh yes, the tax credit. Oh my gosh, how could I forget the tax credit? It's $1,000, guys. If you fall under $73,000 and you are contributing to a 401k or an IRA, you will get $1,000 savings tax credit. Now, what's the difference between getting the deduction and getting a credit? Okay, so The deduction actually reduces your income. So it's just reducing your income, and then you're getting taxed on that taxable income. A credit is a straight up credit. So let's say you owe $3,000 to the government at the end of the year, you're going to get $1,000 off that bill because you've got a credit. So this savings tax credit is another really good incentive if you are one of those lower or mid wage earners. So you want to go ahead and take advantage of that tax credit. Now, I wanted to also discuss one more thing, and I think before I let you go, and if you have any questions, feel free again to make comments in the comment sections. But people might also want to know, what's the difference between a 401k and an IRA? I mean, why can't so how come I can contribute so much more money to a 401k, and I can only put in $6,500, $7,500 into an IRA a year? Well, they have different rules, okay? And so a 401k are a lot stricter. You cannot take that money out without getting a penalty, just about anything, okay? With an IRA, however, you can take money out to purchase a new home. You could take money out without penalty, okay? You could take it out because you have crisis or tragedy, or you have property damage that you need to have repaired, or even the IRS is going to let you take it out to pay your taxes. So so what typically happens is, say that you got a 401k and you want to go ahead and take the distributions out of your 401k and to first-time home buyer, you want to buy a house. Okay, you can take up to $10,000 out of an IRA to buy a house. You can't take $10,000 out of your 401k. You could take a loan against your 401k, and you might be able to get a distribution, but you will be penalized. So if you transfer, let's say, because we have a 60-day rollover, and we transfer 10 grand out of our 401k and we roll it over into an IRA, there you go. We have the ability to eliminate the penalties. Okay, so because you can take out the $10,000 for your first-time home buyers. And first-time home buyers it's just if you don't own a home. It's not necessarily your first house that you buy, just to make that clear. It's just if you don't own a home and this is your first home, you're considered a first-time home buyer. All right, so I think I've pretty much discussed a lot of what I was going to discuss on IRAs. I probably maybe even discussed it too much, and I hope I didn't lose any of you guys. I appreciate you guys sticking on with me, and I was really nervous, and I was kind of really excited. I redid my office wall and everything to make it look nice so I can do my live videos, and I've been preparing for my live interview with Noriko Weinstein on Monday. Super excited about that. And I've got some really cool entrepreneurs that are going to be joining over the next few weeks. So I'm really, really excited about it. I didn't know that there was going to be that much interest in the entrepreneurship series. So I'm really excited. Apparently these entrepreneurs like to talk about themselves. So anyway, so that's great. And there's so much wisdom in these guys and gals that have been doing this, and I'm really excited to have them share their stories and give advice of to avoid the pitfalls of owning your own business. It's not easy. People think, oh, I want to work for myself. It's so I get to work whenever I want to. Yeah, no, you get to work all the time, whether you want to or not. So anyway, I hope you got something out of what I was discussing today. If you would like, I'm going to go ahead and be editing this video and uploading it to my YouTube channel. I just started the YouTube channel. So anyway, I will have those available. If you want the handout or you want me to go ahead and send you the link for the video or for the reel, because this will save as a reel, but it will also be on my YouTube channel. All right, so any questions from you all? You got a quiet class today. Except for Kim, you said you were going to ask me a bunch of questions, and I don't see any. But anyway, okay, let's talk short-term CDs. Oh, short-term CDs. I am not in the business of certificate deposits. Okay, so short-term CDs. Okay, so right now interest rates are at the highest they've been. Everybody knows that, right? And why does the Fed raise interest rates? To get people to start saving money. That's the whole reason they raise it. Stop spending money and start saving some money. But the problem is, a lot of us have credit cards, and along with the interest rates raising, so do our credit card rates. So, it's only for those that actually have enough disposable income that they can actually save some money, or they have some savings. So yes, Kim, I definitely recommend short-term CDs, or high yield bank accounts. They are paying 5%, some of them now, or more. So that is a really good way to make some additional interest on your savings, especially now with the interest rates so high. We really haven't had much incentives to save money because the interest rates are so low, right? So, anyway, so definitely recommend the high yields savings or CDs. Do remember though, you'll make more money, more interest income, more taxable interest income. So that will affect some people and their taxes, depending on how large their savings is and what the high yield bank account is paying. So was I able to answer any of the basically you're going to realize that the longer the CDs and the interest rates, and depending on the short term or the longer term ones, that's how they calculate the yield or the annual percentage rate. It's based on the cost value of money, and with trying to predict what the value of money is going to be in the future. So if they predict that it's going to be high interest rates for the next 3 years, most likely it will be, because the Fed's not going to be really speedy at lowering the rates. It's just not going to happen. So you could go with a longer term CD, and up to 3 years, I would say you'd be pretty safe. But if you just want to make quick ones, 6 months, you do 6 months, 9 months, 12 months CDs. So you could always put it into a 6 months, and if you're still good, then do another 6 months. But your return won't be quite as good as if you were to allow them to hold on to it longer, because they're making the money on it, right? So they're able to pay you the higher interest. So was that helpful? Able to explain a little bit about CDs. Appreciate the question, Kim. Does anybody else have any questions? Anyway, appreciate you. I hope to see you at my next live Facebook on Monday with Norika Weinstein, and again the following Monday with Tris Mahaffey of Mahaffey Amps, and Tuesdays I'll be doing the QuickBooks lesson, and next Thursday I'll be doing another tax advisory session, and I am welcome to some feedback if you have something that you want to ask, if you want some more education on a tax topic. Send me a message, and we'll put together some educational live Facebook for you, and hopefully answer your questions. And how cool is that? You're getting free tax advice. Huh? So, my clients pay me for the tax advice, and I'm just trying to give something of value and I like helping people. And anyway, I'm really looking forward to continuing on with my shows, Ask Jene. So I appreciate you, and again, reach out to me anytime if you have any questions. Anyway, much love to you. Bye bye.